It is 2 minutes past 10 on the 18th of May. Another week begins. All manner of interesting shenanigans to go on, no doubt. And we've also got some interesting editorial content for you this week. So we have been speaking in a lot of these podcasts about how internet applications have really flourished during the Wu flu crisis because everybody's locked down at home. And we've all just been staring at our devices more and more and more, ordering more and more things online. Interestingly, this sort of coincided at a time when 5G was first getting reeled out. So while that began in earnest in across the developed world last year in particular, it was as though the Wu flu arrived just as this next sort of version of the internet was coming out, and everybody was using the internet more and more. Now, this has presented a lot of interesting investing opportunities across the tech sector and also in places like the crypto space as well. And so if you are interested in that, we shall be doing a lot more of a focus on that in our e-letter called Exponential Investor. So do give that a look if you're interested. However, that aside, we shall be dwelling on that with a few of our podcast guests later on this week. That aside, we shall get on with today's market broadcast. And on today's market broadcast, I have my colleague, Nickolai Hubble. Nickolai, thank you very much for joining me. What exactly are you looking at in the market this week?
Yeah, I'm looking at a comparison, I suppose, between two of the investments that are sort of the extreme opposite of each other, and looking at how their prices are performing relative to each other, and then sort of turning that into a narrative for what's going on in the world. So those two assets are gold and silver on the one side, precious metals on the one side, and then bonds on the other, corporate bonds, sovereign bonds, even just mortgage debt, any kind of debt around the world. And what I've started noticing is that precious metals are breaking out to the upside. They're outperforming. We've had a 7-year high in gold in terms of US dollars. In terms of pounds, it's doing even better. Silver has also made an extraordinary comeback in the last few days. And I think that's signaling something relative to what's going on in the debt markets, which is a pretty dire scenario. You've got a huge amount of debt issuance coming up, a huge amount of defaults. You've got a huge amount of debt already in the system. And the quality of that debt, based on how it's rated, is extremely low. You've also got the mortgage market's fears of mass defaults. You've got the mortgage holidays, the repayment holidays in many places around the world. The unemployment's backing up, and the furloughs at some point are going to expire. So I think if you try and think about the world in terms of these two extreme opposites, the gold and silver on the one side and debt on the other, I think it tells you a lot about what's going on.
Yeah, an awful lot to unpackage there. A lot of threads that we could pursue there. I think it's worth sort of dwelling on the debt, sort of the entire debt sector as a whole. What do you think is the real sort of risk for the debt market when it comes to defaults and whether or not those defaults will pose any kind of systemic risk? Because over the last 2 decades, we've had this big explosion in debt of various forms. Now, one of the big sectors that absorbed a lot of that is after the financial crisis was the corporate sector, who they just went really very, very enthusiastically to the bond market in a world of low interest rates to leverage their balance sheets and engage in all manner of financial engineering, as it's called, in order to boost their own returns without actually producing all that much growth. So there's a big explosion in the corporate bond market, just in the sheer size of the sector and the amount of corporate debt that was issued. And a lot's been written about how all of this, well, not all of this, but an awful lot of this has been issued in the triple B band. And triple B is sort of one grade above junk debt. And if it gets downgraded once more, then it will be, loads of investors won't be able to hold it anymore. So they would have to sell it, because they're not authorized by their institutions to actually hold junk debt. So triple B is the final investment grade of them all, from triple A up at the top, and various rating agencies have different ones. But triple B simply being sort of the last stand for investment grade debt before it goes to junk. And all of that debt, or an awful lot of it at least in the last few years, has been issued at that almost junk debt sort of status. And so if those get downgraded, then it's going to be it's going to pose an awful lot of problems for investors who were holding it to begin with. And it's also going to pose an awful lot of problems for junk debt investors who are suddenly given this vast deluge of junk bonds that they are supposed to absorb. And that's something that's been written about a lot. What do you make of that? Or should we be looking at things like sovereign debt, which has also exploded during that period, but is supposedly less risky?
I think you've got to start the narrative a little bit earlier, especially because I come at this from a different angle to how most people see it. So I struggle to explain unless I start from the beginning. But if you look at what happens when governments intervene in the price of something, you get surpluses and shortages depending on whether they set the price too high or too low. I think all economists understand that. You've had the example with the masks play out very recently. I believe it was in France or possibly Brazil, I can't remember now, where they set the price of masks artificially low. And so there was a shortage because manufacturers didn't want to produce and sell them. All of the countries exporting masks sort of shipped them to countries other than the country that had set this artificially low price because they wanted to sell at the higher price. And so manipulating the price of masks in a well-intentioned way ends up causing more of a problem. And I believe the same thing plays out in debt markets. Now, people like Milton Friedman and other libertarian economists, for some reason, they don't apply their own arguments about price controls to debt markets. The price of debt is the interest rate, and we have central banks manipulating interest rates. Now, Milton Friedman was a big advocate of that, but I believe it causes exactly the same problems as if the government controlled the price of anything else. You get shortages and surpluses of debt. And what we've had over the last few years, because of the artificially low interest rate, is too much debt. Governments and even corporates and individuals have all borrowed too much money. At this point, you're in a hole. So what do? You stop digging. Well, that's the opposite of what central bankers are doing. They're trying to lower interest rates, potentially even to negative levels, or already in some places at negative. And you've got obviously QE, which is trying to raise prices to make debt relatively cheaper. So you've got these people are being encouraged to dig in an even deeper hole, even though they're already in too much debt. Now, where does that go wrong? Well, there's a couple of things to consider there. One that's really important is the banking sector. Now, you and I often talk about the share prices of banks, especially in Europe. They're hitting all-time lows fairly often. And that's telling you that there's something broken in the banking sector, which tells you there's something wrong with the debt market as well. And what it is this price fixing regime again. If you fiddle with the interest rates, if the government fiddles with the interest rate, then you end up with a problem in the banking sector. If banks refuse to lend ever more money over time because they're being squeezed by this interest rate hit, then at some point companies will start to default and governments will start to default because they can't find any lenders in the banking system. So I believe the interest rate crunch and QE is actually being counterproductive there. But you've also got to consider, like you were talking about, and there's I think about 40% of investment grade debt in the US is now BBB rated, which means it's just one cut away from being bumped out of the investment grade classification, and that makes it no longer investable for a lot of investors, and that then causes the plunge. Now, because of the low interest rates, companies and people even now, and especially governments, are not borrowing in order to repay that debt at some point. They're borrowing continuously to roll over their debt. And that's not necessarily a problem. It's actually quite a normal way of doing things, even though it sounds pretty dodgy to never repay your debts. But basically, it just allows enhanced capacity of companies and of governments. It allows them to operate at levels that they couldn't if they didn't have access to that financing. So the point being that they constantly need to refinance that debt. They need someone willing to buy it, to lend to them. And that is what could go wrong in both those scenarios, where the banking system struggles and where the investment grade ratings get cut. But if we zoom out a bit or think a few more steps ahead, what we've got is worldwide a situation where if you want to predict what's going to happen, you can't just predict what will go wrong with the type of thing we talk about. You've also got to predict what the policy response will be and how that policy response will work. And in terms of the problems we've been talking about for the last few minutes, if central banks print enough money and do enough bailing out, then they can forestall those problems almost indefinitely, with the only real risk being inflation. If they're offsetting inflation with their policies, then as they see it, they can walk the tightrope, and they can get it just right, where they print just enough money to allow companies to continue to operate instead of defaulting, to allow mortgage borrowers to borrow and governments to roll over their debts. They can continue to do all that without causing the inflation. The question is whether they're right, and historically they've never been right in that sense. But like the authors of the book "This Time Is Different" have recently said, apparently this time really is different.
So could you expand on that a bit when you say whether or not they're right in their policy response? I mean, are you meaning this in sort of a moral in a moral manner, or are you meaning in terms of whether or not this will ease the problem and create more prosperity?
Well, that's the issue at hand, is whether we can continue indefinitely doing what we're doing. At the moment, unemployment is a disaster and businesses are failing. But are we content with a zombie-style economy if it means we all economically survive, but all of the dynamism and the creativity and the creative destruction in the economy ends? Is a zombie who can't feel any pain preferable to a real-life human being? And what we've got on the one side is the people saying that if we don't zombify you, then the whole thing's going to crash. And on the other side, we're saying, well, the crash is the solution. That's what allows the regeneration. So that's a debate that I don't think we're ever going to be allowed to have, because the whole system is designed to keep itself alive. That connection between central banks and governments and banks and large corporates, they're all on the same side, you could say. They're all trying to continue each other's survival because they depend on each other so much. So, whether the morality of it is justified or not, I've got no idea. I don't think it matters so much because I think we're going to get a continuation of these policies for as long as they can continue them.
One of the things I think, one issue I would perhaps have with your argument is you say that we're provided, because within the policy response, there is the assumption that the central bank can always act fast enough in order to offset any problems. And I think the more this system scales, where you have an increase in leverage in general within the system or in various forms, so an increase in debt and an increase in counterparty risk, and an increase just in terms of the connectedness between all of these different firms, and this is magnified across sort of a globalized financial system. When you get that interconnectedness and an ever greater interconnectedness, when one of the nodes falls, the risk it poses to all of the others becomes exponentially larger, and it can move much, much faster. So I always wonder whether or not we do have this belief now in the omnipotence of the central bank, and whatever they say goes. But that all assumes that the central banker would always arrive with the hose pipe on time to save the day,
Yeah, I think I never thought I'd say this to you, Boaz. I think you're lacking in imagination here. I think they're quite capable of arriving in time because the market will bet that they will show up. At this point, we're so conditioned to having a central banker come to rescue the day that the only thing that can go wrong is what happened in 2008 with Lehman Brothers, where everyone expected them to do something and they didn't. The other possible avenue that I would agree with you is Europe, as we've often spoken about, where there is a genuine chance that the central bankers will fail for legal reasons, but laws can be changed too. So at least in terms of predicting what is going to happen, I don't expect things to snap in financial markets first. I think they'll snap elsewhere first in terms of inflation or in terms of political crises.
Right. But then again, we assume that the central bank needs to react swiftly in order to save the day. And against such risks that the market isn't used to pricing in, like inflation and political risk, it seems to me that those could create problems which they wouldn't be able to respond against quite so fast.
Yeah, I think it wouldn't just be speed in those scenarios. I think they just would be out of the realm of what central bankers are capable of. If the last thing standing in the economy is Carnival cruises and the banking system, because the central bank is supporting those two with direct lines of credit, and the rest of everything else in the economy has fallen away, then it doesn't matter how fast they act. It's more a question of where they connect with enough power. And what we're used to is worlds of financial markets where central bankers can act, and they've recently increased their little jurisdiction to include stock markets, for example, and corporate debt directly. But it's not going to be about speed, because I think they're good at freezing the financial system. As you and I write about in the Fleet Street Letter Monthly Alert, they could freeze the system until they impose the fixes. That's another method for them. The speed at which they can operate has rapidly increased, I would say, because of the presumption that they will do so.
Yeah, it's an interesting way of looking at it. It's all about the market's expectations of how it's going to occur. in its own way than changing the pricing of things in order to make it easier for that to happen in the first place.
And that explains the rally in stock markets during the virus. So we had the crash before the virus hit its peak, and then we had the rally from around the peak of the virus. And that's precisely the reverse of what people would expect given what's happening on a day-to-day basis. But of course, markets anticipate. They don't price in the current action. They anticipate what's coming next. So that crash and then rally explains that. And what we've had since is we've had stock markets going sideways, which tells you that their pricing of what is happening in the world has been fairly accurate since the rally.
That's interesting, though, because the market held up very strongly at the beginning of the year while the Wu flu was spreading. While the contagion was really beginning, and there was a lot of there were a lot of people, mostly on the fringe, who were warning that this was going to be a severe economic event. But it took a while until March, really, when things really kicked off.
Yeah, I was surprised by how late, given what's happened, how late the market crashed. But markets are probably not good at pricing in pandemics. They come around every 100 years, literally. But once that unknown becomes better understood, then they reacted rather fast, didn't they?
Yeah, they certainly did react pretty fast, I must say. Let's wind back slightly to what we began this conversation, where you were comparing precious metals and debts in general, which is an interesting sort of comparison, because you describe them as opposites. But there is, of course, our colleague Charlie Morris, who describes gold as a zero coupon bond, so that pays no interest, with infinite duration, so it never gets paid off, and a debt that is effectively issued by God. And so he sees this as effectively an inflation-linked bond with no interest payments in general. And if you compare the price in general for between inflation-linked bonds with a high duration and gold, it generally seems to move roughly in line together. It's an interesting sort of market dynamic of how the market prices gold in general. But that's not how it applies for silver at all. Could you expand on what you've been looking at when you're contrasting the two? Because of course we've seen the gold-silver ratio explode to crazy highs recently. A lot of people think this is a mean reverting dynamic. Some people don't. What's your thinking on it?
Yeah, I think when you look at gold and silver prices, it's difficult because during different sorts of periods in history, they are affected by different things. So if you're in a financial crisis, then gold's value is in the fact that it is precisely not a debt. It cannot be defaulted on. There is no counterparty. You're not relying on anyone else to do what they're required to do in order for you to have the value of your gold. And corporate bonds are the extreme opposite. You're relying on the counterparty, the person who issued the bond, who borrowed the money, to repay. And so that's the opposite extreme, and that opposite extreme is highlighted during periods of financial chaos, as we're in currently, where people are worried about defaults. If you're worried about inflation, then gold and silver will behave very differently again, and the comparison will be made based on a different metric, how well the price performs during inflationary periods. Now, I've always heard people argue every possible case about gold and silver when it comes to things like, is it an inflation hedge? Does it perform well? Does it outperform stocks? I think I saw a chart recently that the gold price has outperformed Warren Buffett's Berkshire Hathaway share price over the last 20 years. Gold's outperformed stocks over many time periods throughout history. So this debate about how does gold perform, you can argue it every which way, and I've seen every which way argument. The point I'm making today is that during a period of financial distress, then the relevant thing about gold is that it can't be defaulted on. And that's why I think it's diverging at the moment. That's why I think gold's hitting all-time highs in many currencies and recent highs or multi-year highs in the US dollar. Because people are realizing that they want an asset that cannot be defaulted on during a time when defaults are going to be the big threat.
Yeah. What do you make of silver in this environment then? Because silver, of course, has, it's got an awful lot of industrial applications. And in those industrial applications, you would expect to be, very, very limited by the Wu flu lockdown and the decline in economic growth that everybody's expecting. So how do you think silver plays into that?
I think that mean reversion argument is a strong one. That the idea of the gold to silver ratio being so out of whack that you should own silver instead of gold. If the industrial applications argument is relevant to the next few years, I think it's going to be in the terms of a recovery. You would think that the economy is going to recover, however slowly. You and I think, argue that it's going to be a lot slower than people expect, but there is still going to be a recovery, and the silver price is at those ridiculous lows. So, I mean, I own silver. I'm pretty sure you do. I think the key message remains that on silver, just as on gold, you can't have a default if you own it in the correct way. And that's going to be what makes it valuable. Hopefully, the mean reversion argument suggests that silver performs even better than gold. But the reason I own both of those metals is not as a speculative position for mean reversion or industrial uses or whatever it may be. I just think at a time like this, capital preservation is key, and being careful about who your counterparty is, or even better, not having a counterparty, is the key.
Quite. Before we finish for today, can you give us, where exactly in that debt market do you think is the greatest risk? So do you think it's in the likes of the Eurozone, in the corporate junk sector? Do you think it might be in the sovereign debt market with the likes of Italy, who cannot print its own currency, so they're at a higher default risk? What is it that you think? Might blindside investors in the downturn that we're experiencing now?
It's a tough one, because if you look historically, it's always been a surprise, and that's why it's been bad. So the Asian financial crisis, it was a tiny Thai property developer who defaulted on a fairly small loan, and that's what kicked things off. And next minute, Russia was going bust, and everything in between was in trouble too. So these things are dangerous precisely because they're difficult to figure out and find. If it was a known or likely obvious source of risk, then the central bankers would be on top of it straight away. I believe the risk remains in the Eurozone because of the political backdrop to that situation and the legalities of it, which we're seeing in the news now. But I've been arguing that for a while. That is the most obvious one if you're thinking about this rationally and analyzing it. But I think it's still more likely that it'll be something that's a surprise. A word that you and I don't even know yet will be the trigger word for explaining what happened over the next 5 years.
Well, perhaps we'll have another podcast whenever we figure out whatever that word actually is. Perhaps we'll have another podcast and we can discuss this one. But until then, Nickolai, thank you very much for joining me on today's podcast.
Pleasure, Boaz.
And that was today's market broadcast. I hope you enjoyed it. It was pretty short this time. We didn't have too much time. But we shall be back again tomorrow. Now, in the meantime, as I said earlier, if you are interested in what's going on in the 5G rollout while we're all under lockdown at the moment, do take a look on exponentialinvestor.com, where my colleagues are doing a lot of work on writing up what exactly is going on with the next evolution of the internet. In the meantime, that is all from us for today. Do give me a follow on Twitter if you're interested. My handle is @FederalAccess, or you can just search for me. My name is Boaz Shoshan. But that's all for today, and we shall be back with you tomorrow.